IPO. So we're going to be going through the highlights, just sharing some of the things that stood out to us from the prospectus. The hope is that we'll be able to just help you, if you haven't read it before, to help you, understand where to focus. If it is that you're trying to make a decision on it, hopefully this session will help you. Before we start, though, I just want to take a moment to acknowledge the presence of the Lord. So, Lord, we thank you for the chance to meet like this. I pray for knowledge, wisdom, and understanding. We pray a blessing on this community, Lord. Amen. So, yeah, so let's actually jump right into it. I'm going to share my screen. All right. So a couple of things. Well, before we start, the very first thing I'll do is share a much needed disclaimer. So the information viewed here is for discussion and illustrative purposes only and should not be construed as professional financial advice, solicitation, or recommendation to buy or sell Sygnus or any other securities that we may mention. So just had to say that. All right, so we are going to start, well, we're gonna follow a specific format here today. We can't go through all, 152 pages, I believe, of the prospectus. We're trying to do this session in an hour. So again, we're gonna focus on the highlights, all right? So you're seeing these in the incorrect order, but this is how we're gonna go through. We're gonna just help you identify what the company does. Many persons, part of the reason why it's hard to invest is that they're not sure what the company does or why they should invest. We're gonna try and answer that question first. Then we're gonna look at what the details of the offer says, the different price points. They have three main pools of shares. So we're gonna try and figure out what they mean for us. We're gonna look at what the financials say. We're gonna look at their dividend policy, which is quite interesting. I'm also gonna identify some key risks that I think you should know as somebody who is considering possibly investing in this. And there are some other things that I got today from the IPO session that they held. Hopefully some persons were able to see it. If not, I'll try to give you the highlights of that as well. So let us start with the company's business. So as it states here, Sygnus, Sygnus REF is a specialty real estate investment company. All right, so it's not the typical real estate stock that you may see on the market. There are two key things about them, and we'll get into the key things later. But I just wanted to look at the words that are highlighted here, right? So they're dedicated to providing flexible financing to unlock value in the real estate assets across the Caribbean region. So that's important. So their focus here is not just Jamaica, right? And they are an alternative investment firm that is solely dedicated to the real estate asset class. What they're saying with this is that they're not going to be looking to any other asset class for revenue. They're going to focus and be creative, whether it be in real estate development, real estate notes, as creative as they can be within the real estate asset class. That's what they're going to do, right? And they're going to provide customized financing solutions in various forms across the credit and equity spectrum. Through the application of flexible financing, they will seek to earn attractive risk-adjusted returns and downside protection. So what that last line is pretty much saying is that in everything that they're seeking to do, they'll try to get the best possible return that they can get while trying to minimize their risk, right? So if you want to understand how you can make money, well, excellent question here, Renee. Let me know, guys, if you're able to see the screen. Hopefully you can. If not, I can try to zoom in. Let me know if you can see it just fine. But everything that I'm looking at here is from the prospectus itself. So I'll show you the areas that I'm looking at now soon. Okay, great. So if you're not able to see it, best to set your phone in landscape or go full screen. All right. So the next thing about them is that they also share their objective, and this is very important as well. So it says the main objective is to bring flexible financing to monetize and unlock value in real estate through active management, and that's something that they spoke a lot about today. One good thing for you to note here, they focus on opportunities with a short to medium term time horizon, right? So 3 to 5 years is what their focus is. What this means, and this is the first thing that stood out to me, is that if you're looking to get the best returns from this stock, your best time horizon to match with this is 3 to 5 years. Now, that doesn't mean that you can't make money in the short term. I will get into that later. But this is their own stated time horizon, which means this is the period for which they're looking to get the best returns for their shareholders. All right. So it says it focus on generating capital appreciation. So if you think how real estate makes money, it's through the increased value, and there's also for them income from the different financing products that they may offer. All right. So from its real estate investments, the company primarily invests in real estate assets using flexible financing instruments, including preference shares, equity, that's joint ventures, land, ordinary shares, etc., asset swaps, profit sharing debt, secured debt, asset-backed debt, mezzanine debt, and other forms of flexible financing. Now, all of that you're seeing, there's just different forms of debt. Now, I'm hoping to just do a tweet later on or tomorrow explaining the different types of debt, but I didn't think it was necessary to go through here. Just understand there are many ways that you can classify debt, and that's all these are. It's not really vital for the session now, but it's important to understand it. So when you see, for example, further information, it will explain, the different types of debt and why they would choose that. So it would be important to know, but I didn't think it was important to go through right this minute. All right. So these forms of financing are typically more aligned with unlocking and maximizing the value in the real estate assets. Let's see the last part here. So the company is going to primarily target assets across a broad range of sectors within the real estate asset class, right? So residential, commercial, industrial, and we'll see from the prospectus the different types of properties or land that it would have invested in. So these categories would cover it. So what they're saying is that they're going to try to be as broad as they can within real estate, since they have said that's the only asset class they're focusing on. That's their primary source of revenue. And it says also that they're going to invest in different stages of the real estate life cycle. So whether it be new development, that's called greenfield. Whether it be acquisition, that would be brownfield. Whether it be a foreclosure or anything that would seem like a great opportunity. So one of the things I said today in the session is that they're gonna rule nothing out. So if it is that it would provide an attractive return and it fits their mandate, then they'll do it. All right. So in terms of the offer now, let's look at that. So there are three main pools of shares that you will have. You'll have the first priority or the reserve pool. So what you should note in total, if you look down to the bottom of the screen, you'll see 207,608,341 ordinary shares with the right to upsize a further 38,857,193,000 shares. And that's spread across the three pools. So the main thing to note about the section to the left, those are for shareholders who would have been existing shareholders as at the date of this prospectus. So you would have had to be a shareholder before they came to market to take advantage of the 1790 Jamaican dollars or the US 1170 to get access to that pool. Next, if you are a Sygnus capital investment shareholder as at June 30th, then you will get the discount for $18.30 or is the US equivalent there, and that pool is pretty much 32.5% of the total available shares. And then the non-reserved for persons who don't currently own any Sygnus shares or are a part of the first priority pool, you get the public rate, which is 19.30. And I'll share a screenshot later on where based on their, okay, all right, so I'm going to zoom in. Let me see if I can zoom in a little bit here. I would say maybe try a different screen because let me see here. Okay, let me do this. Is that better? Let me know if that's easier for you to see. If you're on a phone, a PC may be better, but I'm gonna zoom in. Hopefully that can help. All right. So this is these are the three class of shares that I was saying before. So based on the category that you fit in, that would determine the price. Give me 1 second. All right. So these were the different prices I was saying before. So persons who are Sygnus SCI shareholders would benefit from this second section here. For those who don't have any shares currently, your price would be 19.30. All right, and these are the number of shares that are available based on each category, and this is the amount that they're trying to raise overall. All right, so that's that 207 million. And the amount that they will upsize by based on if it is that it's over subscribed, then they would upsize to that amount. All right, perfect. All right, cool. So let me go back to full screen since I think that's easier for everybody to see. All right. All right, so what I did as well is just shared some of the definitions straight from the prospectus. I would have explained all of this just now, so I'm just gonna go through it, but all of this is explained within the prospectus. So if you want to understand which pool of shares you'd be eligible for, this is where you'd look for it. All right, there's also, they have what's called a special share assigned as well, and I'll show you in the prospectus what it says about the special share. We won't talk about it now. And the standard price, I would have mentioned that. There's also, so there are two currencies for which the shares are denominated. There's Jamaican dollar and there's US dollar. Now they mentioned today that there's a cap on the amount that they can raise in US. That would be 15 million US. So the number of shares that would be available can't exceed that cap, right? So just bear that in mind. All right, so, and this is just the amount of money they're seeking to raise. So they're trying to raise 3.9 billion. And it's showing that the number of shares after this would be 405,736,000. So all shares, what it's saying there will rank side by side, and with the existing ordinary shares in the capital of the company, a summary is shared as well, and I'll show you that when we get to the prospectus. And this is a very important part. How they're going to use the money. So they've identified the following in terms of how they plan to use the money from the IPO. So they have a cost of 175,500,000 in terms of the expenses relating to the IPO, and they're going to be repaying the vendor mortgage for 1 billion. Now, based on what I heard today, that vendor mortgage is associated with, I think, the Miami Bay property. and they're gonna invest. And so after that, after they take care of those two expenses, they're gonna keep the rest of the funds to take advantage of other opportunities in the market, right? So that's how they're gonna use the money that they'll raise from the IPO. All right, so I want to look at some of the risks that they would have mentioned. So let me escape of that. Let me go to the prospectus, because I think it's very important to understand the risk with this type of investment. So let me go to that. Should I probably, okay, here we go. All right, so I'm not gonna go through everything. I'm just gonna go through the ones that I think are important to highlight, especially if you're a new investor. So one of the first things that you should note here is that it says there's a risk in relation to this being the very first issue, right? So there's no market that has been made for this. It's not like an IPO where you could use a history of performance. This is a brand new company, first time on the market. So they want you to understand that there is a risk that there is no known market for it so far. So the IPO price should not be taken as indicative of market price of the shares after they're listed. And what this risk is saying, essentially, you can buy it, and there's an equal chance that it goes up or it goes down. All right, so bear that in mind. So they can't give you any assurance that once you buy, for example, at 1930, you're going to see an increase immediately. Now, based on what they say today, and I'll show you that slide soon, they based on what they're projecting that the financials will look like, they are determining that the shares are going to be sold or seen as being at a discount, right? So to them, they're still providing you value regardless of what the market has to say about how the price would likely trade. It mentions here about ordinary stock price fluctuations, and if you're an investor in the stock market, you should understand these risks that are presented. The next one I wanted to highlight here is that there is an opportunity for persons who are existing shareholders. When it gets to the market, they may wish to cash out, or even persons who may purchase for the IPO. If it's not performing the way they expect, persons may cash out, and they may do that at a discount. And we see that sometimes with IPOs where the IPO is for 80 cents, for example, and somebody may sell it for 65 cents or 60 cents. It depends on the person's objective. So as an investor, you want to understand that risk is there. Since it's the real estate asset class that you're investing in, you also have to accept that there is a potential risk. In the Caribbean each year, we have hurricane season for about 4 to 6 months. And so those what they call them, like acts of God, can impact whether the building being completed, existing properties may be damaged and may incur a cost that would need to be repaired. So you need to be aware of that risk to that particular asset class. So every business has some form of risk. They also mentioned here, since the company is registered in St. Lucia, there's a taxation risk that you have to be aware of. Now, they stated on the other page that their intent is to ensure to put themselves in the best position to be compliant with the tax laws in St. Lucia. So this is what it's saying at 710. So if it does not meet the satisfactory requirements, then it could be facing a higher tax than anticipated. And then, of course, that tax is going to impact their overall profitability. So it's something that you should be aware of. There's also the risk that, so since they do financing, there is a potential risk in terms of whether or not the companies they lend to or the projects that they're a part of, there are risks associated with lending money. Right. So if you see the third line here, it's saying, debtors could default, credit worthiness might deteriorate over time. These are things that you do your due diligence, your research, but there's only so much that you can maybe anticipate. And so it's good to just be mindful of that risk as an investor. There's also a portion of risk that is related to the US dollars. Now, they would have benefited from a valuation increase in US dollar, and we'll see that on the balance sheet soon. But there's also a risk that it can go the opposite direction. And there are things to understand that what they'll try to do, as they're saying here, is manage it, right? So they try to manage the risk by matching currencies. They're saying here US will be invested in opportunities that generate US, and similarly for the Jamaican dollar. And they're saying here to mitigate the risk, they may hedge its foreign exchange risk by investing in currency derivatives and buying foreign currency instruments if the investment manager determines that the hedge is necessary. All right. Then there are some other risks that are worth noting. This is the last one I believe that I would have highlighted. They're saying that the Jamaica stock market is relatively small, and the market, it's going to be considered relatively thin compared to larger markets. This means that trades in small quantities can trigger large swings in price, whether up or down. And we see this all the time, right? Somebody may want to sell 10 shares and sell it at 10 to 15% lower than market price. Persons may take that as a sign that the price is about to go down, and it can trigger a chain reaction. These things can happen that aren't within their control. So just something for you to bear in mind. And then final risk, I thought that one was the final, but this one is, I believe. So they're saying that you should understand the risk that is presented with them being concentrated in the real estate asset class, right? So it means essentially don't expect a short turnaround time. Understand the challenges that may come with the industry. There are economic impacts that may cause a slowdown within the industry. Now they're doing their best to mitigate this risk by investing across the different stages and the different types of real estate assets. But just understand that there is a risk. So they're wanting you to have the expectation that you'll get the best return when you look at it for a 3 to 5 year period. All right, and I believe that is it. All right, cool. All right, so after the risks, we're gonna look at the dividend policy, and then we're gonna go to the financials. So they're stating here that, after, well, they are intending to distribute up to 85% of their net income to holders of the ordinary shares in the form of cash dividends. So that is their intended policy. Now, they're also saying that they're proposing to pay dividends twice per year, but they may change that to quarterly depending on, whether or not that seems more practical going forward. So it's good to note in case you are looking at potential dividend stock. All right, so let's look at the financials now. All right, so in terms of the financials, I'm going to start. Well, let us start by probably going through. All right, we're gonna read through the summary first, because I think that makes sense before you look at the actual numbers. So what you should know, attached with every financial statements are typically notes to explain and kind of comment on the performance within the financial statement. So if you're having a hard time understanding statements, read through the notes, just look at what it says, and you'll typically get a good understanding as to how well the company is doing. All right. So let us probably start from the first page. All right. So the company would have been incorporated in August of 2019. So the end of their first financial year would have been August 2020, or the 13-month end would be then. So this would have been their performance as at that date. So this should give you an idea as to how the company makes money. And what I like here is that it's relatively easy to understand. There are no terms here that you should find difficult to understand. Now, if it is that you're having some trouble, then maybe a little bit of research, or maybe asking us in the comments below, and we'll try to explain as best as we can. But the main thing that stood out here, based on how they ended their first year, the main thing to see here is, so remember how they spoke about how they make money, right? So capital appreciation would have seen here valuation gain from an investment property to the tune of 400 million. They would have gotten interest income as well, 76 million. And I'm saying it in million because the balance sheet is in thousands. The statement, the summary of operations, is in thousands. You would have seen they would have realized a loss here on a joint venture. It was recorded at 5.2 million. And those are the main things that stood out to me here. And the EPS as at that point would have been 2.47. And I'm not going to dig into this now because we'll look at the comparative soon. So you'll be able to see it side by side with the most recent one. All right, so I wanted to kind of zoom in on this as well. So it mentions that the valuation, so that 400 million that you saw, the valuation gain was driven by the acquisition of 29.4 acres from Miami Bay, and it was subsequently divided. So what they did was split that 29 into two halves, or kind of divided it up, and then they would have seen one lot representing an investment property and the other representing real estate asset held for sale. All right. So the next thing that they're saying about that same property, the entire property was acquired for 3.5 billion. The financing of which was a customized one. So the vendor mortgage. So remember they mentioned they're repaying a vendor mortgage for 1 billion. And they also gave the person, the seller in this case, shares. And it shows it in the prospectus how much shares they would have given them. I'll share that soon. And then so this is just kind of speaking to that, right? So there was a clear what you saw as well for the first year. There was, in terms of expenses, there were no management fees charged for the first 6 months, I believe it was. The fees were waived, and that would have resulted in a lower expense. And you'll see when we look at the comparative that those fees would have been charged for the most recent financials, but it wasn't charged for the previous year. In short, what that means is that they were able to spend less for this line item, so they would have realized more profit as a result of that, but they did overall better this year. So you'll see what that looks like. And they stated at another place in the prospectus that they are intending to manage these fees to a certain threshold. So the fees are set at 2%, and they would have explained it today that in their perspective, based on the work that the investment manager has to put in, the way that they have to creatively generate revenue, they think 2% is enough for industry best practice. So they have no issues with those fees. So you have to determine whether or not that's a reasonable fee in terms of your perspective. And I don't know why I would have highlighted that one. Let me continue to scroll. Yeah, so this is what I was referring to before in terms of the management fee. So it speaks to that here. So the target for the threshold ratio is 45%, and they want to be sure that let me see what I would have read here. Yeah, so overall the target threshold there would be 3.5% in terms of that, how they manage the balance between, management fees or other costs as it relates to their overall expenses. All right, so this would be the summary of investment activity. I won't look at this here. Let me scroll down some more. So it says here, just for you to note, so it says that, real estate investment notes, and it's a term that, I would have never heard before this prospectus, but it's saying here that it's structured as a preference share with a payment in kind feature. So they mentioned two things here. They get a coupon payment and also a percentage of profits for the project that they would have, written this note for. All right, so it's saying that they will typically exit prior to the maturity date. So if the agreement is for 12 months, they'll try to, exit somewhere before. So this is their strategy for the investment notes that they would give to potential customers. All right, so it says here that the business model requires an initial outsized investment commitment in strategic property investments to build a platform for future growth. On the other hand, growth in real estate investment notes and joint venture partnerships will be more gradual relative to strategic property investments as real estate investment pipeline is executed. So they're speaking about their business model here. And as I said at the start, it's really based on two main things. So what they're saying is just speaking on that. Do I need to, I think when we look at the balance sheet, we can comment on this. All right, that's a summary of the balance sheet. So this is speaking about their liabilities. So it doesn't show it here. I think it shows it's here. So I mean, it's important to note these. So the total for these liabilities would be here. So let me probably go back to this. So this would be their balance sheet as at the end of their last financial year. So as we know, assets would give you liabilities plus shareholders' equity. So these are all the assets that they would have had at that point. And so since this was all the way at August last year, I think we should look at the one comparing the mid-year. So just a comment on the liabilities here. So it's showing you what would have made up that 3.43 billion in liabilities. So they had 1.6 billion in loans and a 1.3 billion promissory note and 336 million in amounts due to related parties. And you can look at this and see everything that the comments would have mentioned, right? So that's for persons just looking at this for the first time, everything that is shown in a table is typically explained. So this would be the financials ending February 2021. So this is one I was saying that you could look at now for a more comparative as to, where they were to where they are now. So hopefully everybody can see this. So this would be the one that we looked at before. This would be the end of the first financial year. This would be the most recent one, February 2021. And this would be how it would compare to the 6 months in the previous year. All right, so some key things that would have, stood out here are what I would have highlighted. So valuation gain 6 months in would have more than doubled the total, income in terms of that valuation gain from the year before. So whereas they would have ended the year with net income of 376 million, they would have ended their 6 months at 873 million, right? So that's very, very attractive to see. And they would have profit attributable to shareholders, doubling from where it was at the end of their last financial year. And as you see here, if you look at even the increase in EPS from the end of their first financial year to where it is, 6 months in, that's definitely looking good based on how it is that their business model works, right? Because all of these numbers have to be taken in context, right? So some other things here that I'd probably want to highlight. You see here, look at the difference in operating expenses, right? So we spoke about that one, where some of the fees would have been waived, within a period for the first year. Those fees weren't waived for the first 6 months. No, so naturally this cost, the operating expense, is gonna increase. So that would have been there as well. And for everything else, I think it's not that it's negligible, but I don't think it's worth noting here. And so they would have spoken of that here. Let me see. Okay, yeah, I wanted to show this next, right? So what they have here is a summary of, the market value of some of the assets that they have, as at and what would have been the original purchase price, right? So some of the key properties that they mentioned, they would have gotten the 29.4 acres of the Miami Bay property. So they bought it for 24. They sold half of it for 19, right? So if you think about that, they would have, so let's say they paid 12 million for the half. They sold that half for 19 and they have half left, right? So if they were to sell it whole, that could potentially would have gained them 38 million. But of course, if they hold it for longer, it could potentially value more down the line, so more profits can be realized there. Property at 56 LMR, the current value is already, this looks like about 20% higher than where it was before, maybe 30%. Am I calculating that right? 300, yeah, 20%. There's also the property at Spanish Pinwood. I think they were saying they broke ground on this recently. There's also a joint venture, and the joint venture just pretty much means that they're in partnership with somebody else, and they have 70% ownership of that property that's stated there. And these are transactions that were closed after February 28th. So why this is important is that this would not be registered on the financial statement as yet. So one of the things they were alluding to on the session that they had today is that the value that they would have already realized since the end of the last financials, you're going to benefit from that at a later date, right? So this is a transaction. I thought, they put it here to show you, how they've been, still working to leverage opportunities within the market. So they, this is what it's showing here. I thought this one where they would have, spent $6 million US and it's now valued $12 million US, that's pretty good. So, I mean, this shows you kind of how they are making their money. All right. So this was important, I think, to note that they spoke about events that may impact earnings. All right. And that's kind of, speaking to some of the transactions that you just saw. So I'll just highlight one that was not on that list. I think this first one was not. Hopefully you can see it. So it's saying 79 million in convertible preference shares were redeemed in full. So there will be no dilutive effect from those going forward. And for July, that's this month, they made the final payment for the acquisition of 3.52 acres of investment property on Hillcrest Avenue, former French Embassy. I think that one was mentioned before. Former French Embassy, yeah, right? So what they're saying is that they would have finished those payments, right? So that as of July 2nd, so that would register in terms of their cash flow statement in terms of investment activity. So let me move forward. So it would speak to just some of the efficiency and expense ratios there. I think I want to go through that. Just scroll past that. And yeah, so I wanted to show you, for those who might not have seen it, some of the properties that they are speaking about in terms of their investments. This one would be One Belmont. So the key things I look for these properties, I look at the funding requirement, how much it's going to cost them, so you understand how much they'll be investing. So if they don't have it in capital, they either have to seek funding for it at some point, or they'll have to maybe liquidate other assets to get the capital. They're targeting completion of this December 2022, and they're looking to do groundbreaking any day now. So just bear that in mind, and then you can see the details of the project. Next one is Pinwood. This one will cost 550 million, and this showing you that it's financed 100% by equity. This one is expected to launch this month, actually. So I don't know if it's launched already. If anybody is here, did we see any notice about that? I don't know. I think it's either close to completion or completed already. Well, as in launched already, I'm not sure. Oh, sorry. Target completion. So the launch date would have been probably the groundbreaking. Yeah, sorry about that. All right, so you can see the details of it here. And this would be investment in terms of USD. So it'll be 100% owned by them. And you see the size and the details, the contractors, etc. Miami Bay, this was the one that we saw they would have sold half of it. So this is the details for it here. So they bought the 29.4 acres. They would have sold 15. And, the investment required was this. So in terms of now developing the land, working on it, etc., they're alluding to that there. And lake spend, you would have seen that as well. All right, and they're showing the estimated project cost. Okay, and former French embassy, that one we saw that they would have closed the transaction for it in terms of the payment. So that's details here. I thought it was interesting to show this one as well. So they would have shown here just allocation of their investments in real estate. So I thought it would be important to see how that would be divvied up. So the type of property here, beachfront, would be 54.3%, and the different classes, just for you to understand how they would have used the funds against the different classes. And this would be the allocation by investment category. So 74% of their investment allocation is in property investments, and then 18.5% in notes, and then in joint ventures, as in partnerships, that would be 7.4%. So that's how they so 74% of their investment funds would have been in properties, right? And they're showing you here the properties that are there. They would have exited one already, and so on. All right, so I think hopefully you're getting a good idea as to what the company does, what it's how it makes its money, things like that. Hopefully that's becoming clearer. They spoke a bit about their pipeline today, that they have projects that are constantly being added to the pipeline, which is a good thing. Bear in mind, they do say that they're pursuing projects with a 3 to 5 year time horizon, but it depends on the type of investment. Of course, some things may not require that length of time, but they're always looking for opportunities. One of the questions David would have asked them today, David Rose, is about their plans to invest in the Caribbean. And what I think, I can't remember the person who responded from the team, but he said, look out for an announcement later on this year So I think what they're pretty much saying to that is you can look to hear about more opportunities within the Caribbean. They also said that if there are opportunities that come through SCI that meets the requirements for Sygnus real estate finance, then they would kind of just share that opportunity or hand it over. So there's benefit of that network and existing relationships that are there. All right, so let me see if there's anything else that's worth looking at. Let's look at the balance sheet summary. All right, so you'd have seen here, let me zoom in just a little bit more. All right, so just remember that the balance sheet is in thousands, so everything that you're seeing is million or billion. So in terms of cash, they have 249 million in cash as at this date. I mean, that was 4 months ago. That is likely to be different now. Investment properties as at that date, land acquisition, deposit on investment property and projects. So the main difference here, so you see at the end of the financial year, they would have had 4.6 billion. At the end of February, they had 3.9. The main difference here would be they had a property held for sale at the end of the year, which would have added to this amount. That property was sold. So, they have more cash now than they did at that point, and they would have, reinvested some of those funds. And of course, their expenses would have been different as well. All right. So, you're just seeing the difference. So based on where they ended the year, they're pretty much almost at that point again in terms of assets within this financial year, right? So for everything that they've done, for all the properties that they've purchased, their assets are pretty much, close to where they would have been at the end of last financial year. And their expenses are listed here. I think I want to look at the liabilities. That should be here. Yep. So the liabilities, so you should note a difference here in terms of total liabilities as well. So if you judge the first 6 months and say they're going to have the same in terms of, well, let me not say it that way. Just look at pretty much the end of the year from last financials to where they are now. So in terms of loans, they would have mentioned that they had that already. That's part of what the IPO proceeds will be used for. And, accounts payable would have been there. So total liabilities from the end of last FY to February would have actually, decreased. So let me see if there's anything else that I would have highlighted here. I believe that's it in terms of what I wanted to show you. There is a screenshot as well that I took today that they would have mentioned. And it's this slide here. Let me go full screen. So what they're saying based on the price of the offer, if you look to the far right, when they did their first, fundraising privately, those shares would have been valued at $13.40. And what they're saying is, their book value at ending October 31st last year would have seen, a value of 15.74. So they would have realized value for these initial shareholders to the tune of 17.5% as at that point. And they're saying pretty much the IPO price is valued in between here. So so their book value based on their financials as at February 28th is now $20, realizing, 50% gain from they started in 2019, and their projected value is $24. So what they're saying with this is that if you purchase for the IPO now, this is a discount that you're getting based on the the adjusted book value. All right, so if you purchase at 1930, that's considered almost a 20% discount. 1830, 24% discount. 1790, that would be for the key, for the first priority share investors. That'd be, you know, almost a 26% discount. So this is what they're saying is a value that you'd be getting participating right now, right? So with everything that they have, you know, coming on stream, they're saying that they're confident that, you know, you're paying a great price for something that is projected to increase in value over time. All right, so that is the end of my review. So let me know if there are any questions, if there's anything that you want me to particularly go over or go through within the prospectus. I try to share the highlights as best as I can. You know, for some persons who wanted to calculate their ratios, see what those look like, you can, you know, do that. I didn't think it was necessary to go through that here. And I believe, I mean, since their 6 months would have ended in February, we should be seeing some financials within the next 2 months, I believe. I think, David, you can confirm that. So, you know, let me know if there are any questions. I'll try to take them here. We will have a spaces to go through this on Saturday night as well for persons who may not be able to make it for tonight. But are there any questions in terms of, you know, what do you think about, you know, what you've seen so far? You know, is it something that you're interested in? You know, tell me in the comments. All right, so I'm not seeing any questions. So since I'm not seeing any questions, I am going to just wrap up here. I was anticipating some questions. All right, so it may take you some time to formalize it. I would say if you have, so actually no, so they were very specific to say that they aren't to be considered a REIT in terms of how funds are invested and how they choose to make their money. So they were very clear in the IPO launch today that they are not to be considered as a REIT. So yes, I think I would have tried to make some notes based on what they were saying. But no. So David, I think David can comment on that as well, because David and I spoke about this last night, and David was you know, explaining that to me as well, that they're not to be considered. So based on how they invest the funds, based on how they make money, they're not to be considered a REIT. Greg is asking if I think the PB discount is sufficient. Sufficient in terms of what? So if it is that you're trying to make so based on those calculations, I think I did them today. They're saying that the I think I sent it in one of the chats that I was having as well. So in terms of that PB and the different discounts, let me try to find it. I posted it in a chat today. I'm gonna try and find it. But I mean, I think it's reasonable for based on where they are. I do think they went out of their way to show the value that they're providing. They used I noticed the use of certain words, you know, strategic, attractive, you know, all of those, you know, nice sounding words. Since it can't be realistically compared with anything else, I don't know. I personally like some of the things that I would have seen in terms of how they perform over time. There's just not enough history to see, you know, whether or not. Yeah, I mean, I think it's okay, Greg. To probably, you know, give you a direct response. Okay, Jam, so I would have answered that question already. So this question from Stevie, would I consider this more or for conservative investors? So in terms of conservative, so actually, depending on how you look at it, it could be considered for both, right? So they're taking on debt, right? So there's a big risk to their business model in terms of, doing loans and financing and notes and stuff like that. But it's a calculated risk. So, and then on the other side, they're investing in real estate. So there's something tangible. Those properties aren't likely to go anywhere. If there's a natural disaster, they're likely insured. So real estate typically is for conservative investors, if you think about it. So there's, as you saw, 74% of their capital was in properties. So I think that would meet the criteria for a conservative investor. Now, if you're so hopefully that answers the question. So depending on how you look at it, if you're comfortable with the risk that they take in terms of their business model, then I think it may suit your purposes just fine. So I would wait on so what I was saying before is that typically I like to I don't like to get into personal picks for stocks, and I like to share the information, provide the insight, and you make your own decision. But I do like what I see personally. I would say that I think I'm definitely going to go over the numbers some more and see. I think that, as I said, they've gone out of their way to show you what the remaining 6 months of the financials will look like. Like they've gone out of their way to show you that already, or give you a very good idea. The expenses aren't going to be hard to calculate, so you'll have a pretty good idea of how they're going to end the year. And so, yeah, I think it's an interesting company. Yeah, so it's yeah. So David, if you're here, share your thoughts on the why it shouldn't be considered a REIT. It's just based on their structure. As I said, it was commented on today in terms of the IPO launch. So yeah, hopefully that helps. Okay. Let me see if there are any other questions. I think we answered them all here. So as I said, we're going to have a Spaces on Saturday as well. So with Spaces on Twitter, you can come on as speaker, ask any questions that you may have. If you're watching this on a replay, join us on Saturday. You can ask your questions there as well. Comment below the video. I do want to say, though, in terms of expectations, I think it's important to set your expectations as an investor. Now, what I see is that you want to be mindful of this perception locally of price versus value. Now, for some investors, $19 is considered expensive. So, I mean, we saw what happened with JHL that has a really nice PE, but persons consider it expensive. There are some persons based on valuation, though, would say, the current price, I think, of $650 is cheap. Same thing here. You have some persons who in their minds think if it's below $5, it's cheap. If it's closer to $20, it may be expensive. And that's only because of the number of shares that they can purchase. What that means is that you need to set your expectation as an investor that if you may be bullish on this company in the short term, the market may not see the same value that you see. It does not mean that it won't do well long term. So it depends on your time horizon. There's no way to really tell. I think you usually can tell if it is that there is an oversubscription, depending on that demand. Then you may see those persons who didn't get their shares during the IPO try and get them on the market. Now, a lot of the shareholders for this are pension funds, and there's actually a slide. There's a section within, let me get to that here. Let me find that. So they would have shown the share position that's going to be there before and after IPO. So I'll share that as well, but that was interesting to look at. But yes, I would, for me, it's trying to determine whether or not the first thing I look at is whether or not it fits my preferences. If it does, then I want to understand, does it fit my time horizon? If it does, then, you know, I take a shot. All right, so David, you're saying page 40. Oh, that's not David. So minimum shares, yes. So minimum share, so you have to so the minimum is 1,000 units, and then in increments of 100. All right, so let me find that as well. That should be somewhere here. But yes, that is correct. Minimum subscription is 1,000 shares. Let me zoom way in. All right. And I see David explaining. Thanks, David. So this is what David is saying. So so though what they're doing would fit the definition of a REIT, they're really a finance company with sole focus on real estate. We saw that in the prospectus, and they're using many different, you know, strategies in terms of financing. You know, they spoke about a scenario when, you know, a person may want to fund a project and may not be able to get all the money from the bank, or they'd be able to supplement that. You know, so things like that would work out in their favor, because they would be getting opportunities to give financing that, you know, the banks would be, you know, possibly turning down. All right, great. So in terms of the dividend policy, I mean, I think it's good. I mean, we know, I think persons would be reasonably, you know, happy with the dividends that they would have been getting from SCI, and this is shaping up to be a good one as well. I mean, that's if your interest is dividends, right? Not everybody invests for dividends. Let me see. I was referring to something that I wanted to just share before we wrap up. But guys, I would say give the prospectus a read. I tried to kind of focus on the salient points. There are some things that you'll only get from reading it yourself, but I would think that we covered some of the most important points. So what this one is saying is that, you know, just bear in mind there could be an over subscription. I don't think we need to dwell on that one. So this would be the share position before IPO. So these would have been the shareholders that would have invested, you know, before they're coming to the market. So we see pension fund there, and, you know, that's the largest allocation that's there. So the top 10 shareholders make up about 70%, and the other shareholders would be there. And then they show the after IPO. All right. So, you know, you're seeing a lot of, you know, pension funds. And so, I mean, that's where a large amount of their funding has come from so far. And my guess is that you may have, you know, more of those funds seeking to take advantage of this. Now, what that means, and you'd have seen them highlight the risk that small volumes can lead to shifts in price. Because if it's a pension fund that's purchasing, then those funds typically aren't looking for short term. So the price in terms of volatility are likely to be moved by the retail investors that are looking for maybe short term. But I thought this was, you know, interesting to go through to see where, you know, most of their shares would have been allocated. All right. All right, cool. So I think there are no other questions. Thanks, David, for answering some of those comments. Yeah, 85%. Yeah. Yeah, Richardo, it's a long time that I haven't seen you. It's good to see you. All right, everyone. Once again, thank you for joining us tonight. Hopefully you learned something from this session. If you did, I'm asking you to leave us a like. It would really, really help out the channel. And I would greatly appreciate it. If you have not subscribed, please subscribe. Next week, what we're going to try and do is, so we have 2 more meetings for the end of this month. And then we're actually going to be taking a break for August. So I just wanted to announce that here. So we'll have no live meetings for August. I'll be pre-recording some videos and posting them. So if you have topics that you'd want us to cover, leave it in the comments below the video. I'll try to record the video before the end of the month and publish it in August. But apart from the topics for next week, we're not going to be going live again until September. All right. So the spaces start at 7 p.m. So follow us on Twitter. We're at Learn, Grow, Invest. And I'll be retweeting the spaces a little bit later so you can see it. Guys, we'll be back. So what we want to do is kind of put a little bit more planning. We've been going, 2 or 3 videos per week. We want to kind of slow down, get some things out the way in terms of just automating the process so we can provide even more videos. All right. All right, cool. So I'll see you guys in the next one.